So in the aftermath of the US election, there's so many things going on, but the thing I want to focus on is the dollar. It's something that I've been concentrating on for a while, and I think some of the dynamics have changed seriously and very importantly. If you remember, the dollar's been trending higher for an extended period of time now. Much of it was driven originally by some of the change in central bank policy as the BOJ were easing and the Fed were looking at tightening. And that kind of moved in and sucked in market participants, and parts of the carry trade got caught in, emerging markets got caught out, and the oil price fell with it. After that phase, which finished in January this year, things have been very stable in the dollar since. But then as soon as the election result came, things turned around dramatically and the dollar has been on an absolute tear. We've now broken the chart patterns. If you look at the chart of the DXY, you can see it's now broken that consolidation pattern and is now headed much higher. So this is now the next phase, and I think the accelerated phase of the trend higher in the dollar. We also have the same kind of breaks going on in the euro, which broke a consolidation pattern and is about to break a larger pattern here. And also things like dollar yen have started moving as well, finally in the direction that I've been hoping for some time, which is to see the dollar rising against the yen. The RMB has also been falling dramatically against the dollar, and all around the world currencies started shifting. The Asian currency index of ADXY, that's also starting to fall dramatically against the dollar. So what happened in the election that's changed things? Well, part of it was nothing's changed in the fact that that trend was there and we were kind of waiting for the next catalyst to bring it along. But the catalyst of Trump being elected was something that people don't really perceive why. Firstly, they look at rates and realize that rates backed up very sharply. And I think Julian Brigden's going to be talking about rates in this US election special. But that backup in rates obviously makes the US dollar more attractive. So US rates are much higher. It's a high yielding bond now versus virtually any other major currency. So that's an important thing. So that started to get people and traders involved. But there's a bigger picture backdrop, which is based on the election, which is the fact that Trump's policies are very clearly protectionist. This is one of the things I think he will likely try and push through, whether it's the breakup of TPP or some renegotiation of other trade deals. Now, the point being is the world is dollar starved. And if there's a shortage of offshore dollar funding, the Eurodollar market, and Trump starts protectionist policies, it means less dollars flow into the global system because they're doing less trade with the US. And that means there's just not enough dollars to go around for all those people who borrowed dollars. And so that in itself is an extremely positive outcome for the dollar, and something I don't think Trump realizes, because he's imagining that the protectionist policies will help US industry, but the problem is US earnings are going to fall because of it. In addition, exports are going to fall and imports will rise, which is kind of the opposite of what he was trying to do. But let's see how that plays out over time. And I'm not here to pass judgment on his policies. I'm here to talk about the market impacts of these things. So the dollar is rising because there's a perceived lack of dollars in the outside system. And we've seen this in the LIBOR market, which is the London Bank interbank offered rate. And that's been rising along with the risk of US interest rates rising. But the other reason it's been rising is because monies keep getting taken out of that offshore funding market and being put onshore in the US. So for example, the money market fund change recently meant that money market funds who put their money in that Eurodollar market into the kind of secondary markets have now gone and put it in the Fed funds market. So that's taken about $1 trillion or so out of the traditional money markets. Okay, so that becomes concerning when you look at what the BIS have been talking about, which is this $10 trillion shortfall of dollars out there where people have borrowed dollars, and as the dollar rises, they're scrambling to pay it back or secure new funding, but the funding costs are going up as well. So it's creating a real problem for people having to pile into dollars. Now, as the dollar starts to accelerate on these twin changes that have gone on, i.e. interest rate rise and the trade policies, it's going to suck in more people into that position where they're going to have to decide what to do with their shortage of dollars. Because don't forget, they've all borrowed dollars. And that Eurodollar market is them essentially borrowing dollars from the European banking system, the Japanese banking system, and elsewhere outside of the US banking system. And that's where there aren't enough dollars around. The other thing that's happened is, or is likely to happen, is there's going to be some sort of repatriation of corporate profits. Both Clinton was talking about this and Trump was. And I think they'll do it. I think it was Bush originally did it way back in the early 2000s. It was the Homeland Investment Act at the time. And the idea there is that corporations can bring back all of those profits, all that money they've hoarded offshore, bring into the US for a small tax penalty, and then that money can be implemented either in infrastructure or whatever other policies the governments are trying to do. Now, what's interesting there is you're bringing, obviously, if companies have holdings in foreign currencies, euros, whatever, they will sell those euros, buy dollars, bring them back, pay the small tax. So that automatically pushes the dollar up yet again. But the more important factor is not those guys with the foreign currencies, because most US corporations don't want to hold too much foreign currency because their earnings are in dollars and they're reporting dollars. It's people like Apple. They have hundreds of billions of dollars in US dollars cash, but in the European banking system. So what do they do with that? Well, they start to take it to the US banking system, and that again takes hundreds of billions of dollars out of that Eurodollar market. So there's more sucking out of that market, and all of these borrowers are going to be scrambling to find funding. It means that the Fed are going to end up having to extend swap lines all over the world to allow some dollar liquidity, but rates are going to go higher for this. It's going to get harder to borrow money, and that means that people are going to have to buy more and more dollars over time. Now, the thing about currencies is they trend for extended periods, and it's something I've talked about in Real Vision quite over the last 2 years now, is that the dollar has only moved up about 30% in this entire bull market. That's against 50% back in the late 90s and 100% in the early 80s. My target has always been that this bull market is going to be a very big one. And that's probably going to mean it's somewhere between 50% and 100%. So I think the rise from here is at least another 30%. Now, there are also knock-on ramifications for all of this. China, as you can see, is devaluing its currency rather rapidly. But we're going to find that currencies are going to start falling sharply. We're going to expose weak currencies. We've seen it in Egypt already. I think Turkey is going to get itself in a mess, and that's going to spread around the emerging markets. But also in that kind of protectionist world, countries like Korea and all the big exporting nations of Asia are going to get caught in the crosswinds. And, you know, I've been bearish on Korea for some time. It's not been the best bet. It worked last year, didn't work this year. But I think Korea and other countries like that, Taiwan, are going to struggle in this environment. They're going to struggle if the yen is weakening, which it is now. They're going to struggle if the RMB is weakening, and they're going to have to weaken their currencies themselves. And that's probably going to mean weaker stock markets as well, because global dollar earnings are going to fall. And we saw that there was a big feature of this year and last year is world trade is shrinking. So the globalization element of the world is definitely reversing, and the world is becoming slightly more insular. And that again means less world trade, less dollars in the system, and that makes it very complicated. So I think for me, the key thing from this Trump victory to focus on in markets is the dollar. I think it's a relatively easy, clean trade. It's moved very sharply recently, so I think the chance of a correction going into year end as people square up their books is relatively high. But at that point, I think 2017 is going to be another shockingly strong year for the dollar, and that will have macro implications beyond that. The law of unintended consequences will suggest that it's going to knock onto the US economy and the global economy overall. The overall bullishness in, for example, in oil prices is likely to be misguided. And I think we need to be very cautious about how 2017 plays out.